You got the job, you negotiated the salary, 50,000 rupees a month. Sounds solid, right? But then salary day comes. You check your account, and instead of 50,000 rupees, you see 38,000 rupees, maybe even less. Where did 12,000 rupees go? Nobody stole it. Nobody made a mistake. The system just quietly took it. And most people have absolutely no idea how. In this video, I'm going to break down exactly where your salary disappears before it even hits your account, and more importantly, what you can legally do to keep more of it. Stay till the end, because I'm going to show you a real example of how someone on 50,000 rupees can legally save up to 8,000 rupees every single month just by understanding this one thing. First, let's talk about the biggest lie in every offer letter. When a company says they're offering you 6 lakh rupees per annum, that number is called your CTC, cost to company. And here's what most freshers don't realize. CTC is not what you take home. CTC is what the company spends on you. Those are two completely different things. Let me show you exactly what 6 lakh rupees per annum, that's 50,000 rupees per month, actually looks like when it hits your account. Your CTC of 50,000 rupees is split into multiple components. Basic salary, usually 40 to 50% of CTC, so around 20,000 rupees to 25,000 rupees. Then HRA, house rent allowance, then special allowance, then PF contribution, then maybe a performance bonus, and then the government's share, TDS, tax deducted at source. By the time all of this is accounted for, your in-hand salary on a 50,000 rupees CTC is typically somewhere between 38,000 rupees and 42,000 rupees. That gap, that 8,000 rupees to 12,000 rupees, is not gone forever. But if you don't know where it went, you can never get any of it back. Let's go one by one. Number 1, PF Provident Fund. Every month, 12% of your basic salary is deducted as your EPF contribution. If your basic is 20,000 rupees, that's 2,400 rupees gone every month. Now here's the thing, your employer also contributes another 12%. So 4,800 rupees total goes into your PF account every month. This is your money. It's just locked away. It earns around 8.1% interest annually, which is actually decent. But the problem is, most young people have no idea this account even exists. Number 2, professional tax. This is a state government tax. Ranges from 150 rupees to 200 rupees per month depending on which state you're in. Small amount, but it's there every single month. Number 3, TDS, tax deducted at source. This is the big one. Your employer estimates your annual tax liability and deducts it in equal monthly installments. If your annual income falls in the 5% slab, you're paying roughly 800 rupees to 1,500 rupees per month in TDS. If you're in the 20% slab, it can be 5,000 rupees to 8,000 rupees per month. And here's what most people don't know. If you declare your investments and deductions to your employer at the start of the year, they reduce your TDS, meaning more money in your pocket every single month. Not at the end of the year, every month. Number 4, health insurance premium. Many companies offer group health insurance and deduct the premium directly from your salary. Usually 500 rupees to 1,500 rupees per month. This one is actually worth it. A 5 lakh rupees health cover for 500 rupees a month is a good deal. But again, most people don't even know it's being deducted. Now let's talk about income tax. Because this is where most people lose the most money simply by not understanding how the system works. India has 2 tax regimes right now, the old regime and the new regime. And choosing the wrong one can cost you lakhs over your career. Under the new regime, the tax slabs in 2026 look like this. Up to 3 lakh rupees, 0 tax. 3 lakh rupees to 7 lakh rupees, 5%. 7 lakh rupees to 10 lakh rupees, 10%. 10 lakh rupees to 12 lakh rupees, 15%. 12 lakh rupees to 15 lakh rupees, 20%. Above 15 lakhs rupees, 30%. Now here's the critical thing most people misunderstand. These slabs are not applied to your entire income. They're applied progressively. So if you earn 10 lakh rupees, you don't pay 10% on the whole 10 lakh rupees. You pay 0 on the first 3 lakh rupees, 5% on the next 4 lakh rupees, and 10% only on the last 3 lakh rupees. This is called marginal taxation. And understanding this single concept can change how you think about your salary forever. So which regime should you pick? Old or new? The new regime has lower tax rates, but you lose most deductions. The old regime has higher rates, but you can claim deductions under sections like 80C, 80D, HRA, which can massively reduce your taxable income. Here's the simple rule. If you have investments and deductions above 1.5 lakh rupees per year, stick with the old regime. You will pay less tax. If you're a fresher with no investments and no rent, The new regime is simpler and often better. Let me give you a real example. Rahul earns 8 lakh rupees per year. Under the new regime, he pays around 54,000 rupees in tax. Under the old regime, he invests 1.5 lakh rupees in ELSS under ATC, pays rent and claims HRA, and his tax drops to around 28,000 rupees. That's a saving of 26,000 rupees per year. Just by choosing the right regime and declaring his investments, 26,000 rupees saved. That's more than 3 months of SIP investment. For free. Now the part you've been waiting for. Here's exactly how to legally keep more of your salary every month. 1. Section 80C. 1.5 lakh rupees deduction. Invest in ELSS mutual funds, PPF, EPF, or pay life insurance premium. Up to 1.5 lakhs of this is completely deducted from your taxable income. This alone saves you 15,000 to 45,000 rupees in tax depending on your slab. 2. HRA exemption. If you pay rent, declare it to your employer. A portion of your HRA is completely tax-free. If you pay 10,000 rupees rent per month in a metro city, you could save 30,000 rupees to 50,000 rupees in tax annually. Get rent receipts? Submit them. Done. 3. Section 80D health insurance. Premium paid for your own health insurance, up to 25,000 rupees, is tax deductible. Premium paid for parents, another 50,000 rupees. This is free tax saving that most salaried employees completely ignore. 4. NPS, National Pension Scheme. Under Section 80C(1)(b), you get an additional 50,000 rupees deduction over and above the ATC limit. Invest 50,000 rupees in NPS, save up to 15,000 rupees in tax. The returns are decent and it builds your retirement corpus. 5. Submit your investment declaration on time. Every January, your employer asks for investment proof. Most people either ignore this or submit it late. If you submit properly, your TDS for the remaining months drops significantly. More money in hand every month. Not just at tax filing time. Let me bring this all together with one real example. Rahul, 8 lakh rupees per year, 66,667 rupees per month, CTC. Before optimization, in-hand salary, 51,000 rupees per month, tax paid, 54,000 rupees per year. After optimization, ADC investment of 1.5 lakhs rupees, HRA declaration, ADD health insurance, NPS contribution of 50,000 rupees. New tax liability, 12,000 rupees per year. Saving, 42,000 rupees per year. That's 3,500 rupees extra per month. Every single month, just from understanding and using the tax system correctly. Rahul didn't get a raise, he didn't change jobs, he just learned how the system works and used it. The salary you see on your offer letter and the salary you actually live on are two different numbers. Now you know why, and more importantly, you know exactly what to do about it. If this video helped you, subscribe. Because next week I'm covering the 5 credit cards every Indian under 30 should know about, and how to use them to actually make money instead of losing it. Drop a comment with your CTC, and I'll tell you which regime you should be on. See you next week.